Swayam Prabha. Digital India. Educated India.
We were talking of treasury bills. Treasury bills are a common method, common instrument for government to find finances to fund its deficit. Government budgets are often in a deficit. May not be on an annual basis often, but periodic deficits are there throughout the year because the tax receipts and the income do not always come regularly. So they come, every 6 months or so. So how would government run its business? It has a whole lot of expenses, just not salaries and overheads. They have these dignitaries, delegates coming and, huge amount of expenses. They send people off to foreign countries. Now, treasury bill is common across all countries, but all countries do not have the same kind of treasury bills. In India, initially there used to be a regular treasury bill, 91-day bill, and ad hoc treasury bill, which was also 91-day. And some bills were available on tap. The tap one I found was primarily for the state governments. If they have surpluses, they can go and buy that on tap, primarily for state governments. But they have stopped both on tap and the ad hoc because there were problems they were having, and they converted it in some kind of a console with a fixed interest rate like 4.68 or 4.64% or something to band. And when I opened RBI site, I found, yes, the data is correct. I mean, it conforms to what I have heard or what I've read. The regular ones that are available are three types primarily: 91-day, 182-day, and 364-day. I will show the data to you later. The regular ones, there are slight differences. The 91-day, usually a weekly tender it used to be. Now they have a weekly auction system, and there are competitive and non-competitive bidders. The 182-day, very interesting. It never specifies an amount. It says, we are selling 182-day. Who is interested? The buyers, the bidders come, they bid, usually the banks. And they also allow, if you accept that bidding rate, if you also allow the non-bidders to invest for the 182-day bill. The 91-day is more formal. They would announce an amount, a date of auction, then they would come and they bid and they buy. 182-day, no specified amount is mentioned by government or RBI, and RBI is the principal underwriter of this. So I can interchangeably use RBI and government. The good thing about not specifying an amount is there used to be an issue. RBI used to have a problem of devolvement. Whenever an amount is announced, and if the market players don't buy them, there is a balance, it used to fall on RBI's shoulder to purchase the residual amount. In case of not specifying a fixed amount, there is no issue of devolvement anymore, because there is no fixed amount that has to be sold. Whatever is sold, sold. The same thing I found with 364-day. There used to be no issue of devolvement, and there are competitive bidders as well as some non-competitive buyers buying them. The final thing that I want to mention, which is just for historical reason, it's a fact, it's not alive anymore, this issue. They introduced for a few years, about 2-3 years, a 14-day treasury bill, 2 weeks, primarily for the state governments. If they have surpluses, they can invest. 14-day treasury bills. And this 14-day, such a short time, the bills were not transferable. Usually treasury bills are transferable, remember. Treasury bills, 91-day, 182-day, 364-day, I don't know whether I mentioned this, treasury bills are transferable. You understand transferable? You can sell it off in the second-hand market to somebody else. But the 14-day bill was such a short bill, it wasn't transferable. They did that because they say there are often little bit of surplus that lying with state governments, and state governments want to make some money on it and they don't know where to put it for a very short period. So state governments were allowed, it's like the replacement of the bill on tap, which was earlier there. You come in, invest, okay, 14 days over, you are unhappy, so quickly it is over. Okay, we would renew that. That kind of a business they started. For 14 days, only 2 weeks. All right, okay, we will, like a call market loan, the notice money, it's over. Oh, so unhappy. If you want to keep the surplus for a longer time, okay, we will renew it. They would keep on renewing it. And small amounts, what I found, the figures were like 300 crores, 400 crores, something like that. Hardly it was there, not much money, small surpluses, like small savers' money. These bills were not transferable. They would expire after 14 days, and they would set an interest rate. It wasn't really marketable. They would set an interest rate. Like more or less that on-tap thing. On-tap means what? The price has to be announced. It is continuously, you can open the tap anytime. So that there has to be a price. People will look at the price. Do I open the tap? Yes, okay. Suppose there is a Coca-Cola tap. Price has to be mentioned. Okay, I can open the tap, buy Coca-Cola the amount I want, and this is the price. So on tap, like a thing, it was replacing it. So they used to announce a price, not market determined. And there is something written in my notes which you won't understand. It's similar to the price or the interest rate that is they announce on WMA. WMA, I will talk about that in the next topic. WMA is Ways and Means Advances. This is another source of funds for government from RBI. WMA, Ways and Means Advances. I haven't talked about that. I'll talk about that later. So the interest rate on WMA was often the interest rate on this 14-day bill. But hardly it was there. Problem is hardly it was there. It was from the beginning of the financial 1998 and finally 2001 May, which is 98, 99, 2000. 2 years it was there. Only for 2 years this bill was there. And they were discontinued from May. May is roughly a month, more than a month and a half more than 2 years. 14 May it was discontinued. So it never gathered importance. For some reason they found probably that the 91-day bill, regular bill, good enough for these state governments. State governments don't really need that short-term bills for the surpluses. If they want to park the surpluses, if they have somewhere, they are happy to go for the 91-day bill. So the 14-day short duration maturity bill wasn't required. It's gone. It's no longer there. All right. So this is about treasury bills. Now, I come to a very interesting short-term money market instrument called repo. So I would talk about the repo and let's see whether you understand this repo business or not. This is different from the call market, and often these two markets compete. There are two types of items here, instruments. One is called repo, the other one is called reverse repo. Both are same thing, repo and reverse repo. Repo and reverse repo. Okay. It depends upon from whose point of view you look at it. It can be a repo, it can be called, from another point of view, it can be called a reverse repo. From RBI's point of view, it has a definite meaning. reverse repo from RBI's point of view, RBI vis-a-vis banking system, when the transaction going on in reverse repo, it is absorption of money from the system. Absorption of money from the system. Reverse repo. So, reverse repo meant absorption of funds from the system. It has a policy issue. So, when RBI does reverse repo transaction with the banking system, it has a definite issue in mind, a definite objective in mind, which is to absorb surpluses. So, there is excess rainfall. I need to drain out that water, excess water, which is not required in the paddy fields. So, I need a drainage system. Now, there hasn't been rain like this year, drought, then they go for repo transactions, which is injection of funds into the system. There is a policy issue, but from the point of view of an ordinary buyer and seller, repo and reverse repo, it depends who is doing it. Sometimes it's the same thing. I will explain that. So, repo means injection of funds and reverse repo means absorption of funds. Injection of funds and absorption of funds. This has a definite policy issue or matter involved here, and that's why it has become very important. So, what RBI does is that it controls the market. The call market is primarily interbank call market, it cannot really control it. But to have a control on the bank, they can use CRR and repo. These are the two most active monetary policy instrument that Reserve Bank of India has. It is not the same thing with other countries. They may have repos, etc. In other countries like US or European countries, there is an instrument called bank rate, which is very important. In US, it is called the federal rate. So, the bank rate is important. I will talk about that in the next topic. In our country, the most important monetary policy instruments are two, what I have understood. One is the CRR, SLR hardly changes, which they use a lot, and it will come on news on TV as news item on TV. Whenever RBI announces a policy, you will hear two things, CRR and the repo thing. You keep your eyes open, you will see that. So, what reverse repo is doing, absorption of funds. If there is excess rainfall, drain out the water, which is in this case money, and injection of funds is that there is a drought, there is a shortage of funds in the money market, so pump in money. Simple, keep a balance. Okay. Now, let us go back to the Bhole kind of a discussion, Professor Bhole's book. What does he say? This you can read from Bhole also. Repo means, what I have read from his book means repurchase agreement. Repo, repurchase agreement. This is the meaning of repo. Repurchase agreement. What does repo mean? Repurchase agreement. There is another expression that is found, which has been abbreviated repo. In some countries they call that probably ready forward agreement. Ready forward agreement. Ready forward agreement. Repurchase agreement and ready forward agreement. Repurchase agreement, ready. In short, they are called repo. How does it work? It works in the following way. Is a financial transaction going on between two parties, all right, say RBI and a bank. So, one of these parties is selling a security. Say RBI is selling a security to the bank, all right. When it sells the security, there is an agreement with the buyer, which is the bank, that I will repurchase it from you at a specified date. He is not going to be with you forever. 24 hours later, 2 weeks later, 1 month later, 2 months later, 3 months later. I am selling the security to you, so in return you are giving me money, but remember, this is a temporary transaction, you do not own it forever. We have an agreement here, forward agreement, which will happen later. Forward means in future it will happen, that I will repurchase it from you. When I repurchase, of course, I will give you more than the cost price when you sold it or when I bought it, because that will be your income. All right? I am selling a security, I need the cash from you. RBI is saying to the bank, suppose. I am selling the security, I need the cash from you, with an agreement that I will repay this money within 2 weeks with an interest, which is the repo rate, call rate, repo rate, CD rate, CP rate, whatever, which is the interest rate. So it has a transaction with an agreement when in future it will be bought back. It will reverse the process. Now, why would RBI sell the security? It wants to mop up the funds. Too much money is there with the banks. This is one of the standard reasons. All right? So this is absorption of funds. This kind of a transaction, if RBI does that with banks, banks are lying with banks, banks are happy to give the money, park the money with RBI, because he's lying idle. Too much money, they don't need it. They cannot give out as loans, they don't have avenues to invest. So banks are also happy to give that money, park that money temporarily with RBI. This is absorption of funds, and this transaction, what I just explained, is a reverse repo transaction, because reverse repo is saying absorption of funds from the system. All right? Now, you take the case, banks don't have money. So, banks are selling securities now to RBI. But banks are saying, and RBI is also telling them, okay, I would buy it, I will give you the funds with an agreement when you would return the money to me and get back and take back your security. Like, I am keeping some valuable with you, bhai, thoda pakad lijiye isko, give me some cash, I am coming in 2 weeks' time, I will return the money to you and take my motorcycle back. I need money, so I keep the motorcycle with you. Same thing, banks now need cash, so banks will park their securities, sell their securities temporarily to RBI, RBI will give them the cash, so money is flowing into the economy, because banks are part of the economy. Banks, non-banks, whatever, whoever can do repo transactions, and then it can then later buy it back and return the money to RBI. This is a repo transaction, because money temporarily flows into the system, injection of funds, money flows temporarily into the system and then it's withdrawn later. All right. Now, you think that the repo transactions are only between the central bank, and reverse repo transactions only between the central bank in India and the banks? No. It's a competitive market. So these repo transactions, reverse repo transactions are also there between banks, between financial institutions. Now you would think, why would, is that always that there is a surplus funds, that's why I go for an absorption, reverse repo, or there is a deficit money with me, so I'm in shortage of funds, so I go for a repo transaction, so funds are injected into the system, all right? Okay. The thing is, often these transactions, I'm coming to that, are not because of shortage of funds and surplus of funds. Sometimes these transactions are also there because securities are an essential part of SLR. I will talk about that. And cash is always helpful for banks because they have CRR. So banks basically require both cash and securities. Suppose it hasn't invested in the past in securities which they are supposed to show in SLR. Now the problem is, now time has come to declare the SLR amount to RBI. I don't have sufficient securities. Temporarily for 2 weeks, 1 month, I can buy somebody else's securities if I have money and show to RBI, yes, I have securities, and then dispose them off as soon as the period is over. So often there are SLR, CRR obligations which drive repo transactions. There's no shortage of funds or surplus of funds. Okay. Now, therefore, the reverse repo, as I told you, is essentially a buyer purchasing a security from a seller with an agreement to sell it back. Buyer purchases a security from a seller with an agreement to sell it back to the seller in future at a specified date at a higher price. Okay. Repo transactions and reverse repo transactions. So, but remember, the international definition of reverse repo is absorption of funds from the system, and repo is injection of funds. Funnily enough, when I was looking up the data, in India for a long time the definition they were using and the numbers they were supplying to us, for instance, on their site on repo and reverse repo for a long time, I will tell you since when, in India everything goes wrong. In India they were using just the opposite of the international definition which I wrote on the board. So, for a long time their data tables, what showed as reverse repo was actually the numbers for repo, and what they were showing as repo were actually the numbers for reverse repo. When I started looking at the numbers, I said, my goodness, it was so different, because it wasn't making much sense, because these numbers have a trend, as a pattern to show. In India, for instance, reverse repo these days is very common, not repo so much. So I was thinking, my goodness, so different. It was, I was thinking, oh. Then I found suddenly there is a footnote, and I think I have in my notes when it changed. Suddenly there was a footnote and saying, sorry, we were using just the opposite definition to the international definition. From today onwards, this transaction, reverse repo would mean what we used to call repo, and repo would mean what we used to call reverse repo. The date was 29th October 2004. So, only recently, 29th October 2004, finally they corrected the definitions. So, until then, whoever did any work, any study with the repo and the reverse repo data probably got brilliant results, unusual results, but remember all, if they have not paid attention, the numbers were reporting for just the other variable. The repo column was showing data for the reverse repo column. Now, if you want to find out, you can open RBI Bulletin 29 October 2004, you will find a footnote there in the repo table. All right. So, be careful when you look at the tables. Achha. Now, why were these? They have become important in all countries. In India, I will talk about in India. I have already told you the number of a few reasons. Let me just list them. I have the reasons listed here. One is the shortfall in cash often drives banks to go for a repo transaction. Okay. If they have valuables, they mortgage them, get the cash temporarily, and then when they return the cash, they get back the valuables, and the valuables in this case are securities. And I will come to that. What kind of securities? There were all kinds of securities, CP, CD, everything could be used. Mutual funds, shares, bonds, government bonds, papers, short-term treasury bills, short money market instruments. There are securities also. Government dated securities, which are bonds, long-term ones, 5-year, 3-year, 8-year, 10-year period. All right. Often, if banks have surplus funds, they will go for a repo transaction or something. All right, lend it to somebody and earn something. Quickly, you make some money. Then, of course, securities are required for banks to obtain for SLR requirement. So, they would borrow security from somebody. Like I tell you something, this looks very odd, if you don't mind if I give you an example like that. Suppose in real life, in personal life, it doesn't happen. But in case of a bank or business life, it can happen. You actually are showing somebody else's security as your security, and RBI is saying it's okay to do that. SLR requires some securities to be shown that you have invested. Now, here you often borrow other people's securities to show, ye hai mera security, but actually they were not your securities, they were invested them. Temporarily you borrow them. Okay. So, SLR CRR is one thing, and of course, the one that I mentioned right in the beginning, the data that I have is very interesting about RBI data. RBI publishes no market repo transaction data. Very unfortunate. Market transaction data means where the repo transactions or the reverse repo transactions are going on between institutions in the market, between banks and non-banks, within banks, like call market. In case of call market, they have extensive data on interbank transactions and the call rate. Okay? They don't have data on the RBI agent activities, DFHI activities. In case of repo, it's just the opposite data they are supplying. They don't have any data on market related transactions. I looked and looked what was the repo rate, couldn't find, and the amount, the volume. All data they have is, the first point that I mentioned is monetary policy data with respect to monetary policy, RBI interventions. So, whenever RBI is involved in repo transactions with the rest of the economy, where banks mostly participate, non-banks can also come in, even cooperative banks participate. That data I have, and on TV what you hear is these policy announcements as to what the repo rate is going to be, what the reverse repo rate is going to be, etc. Because they are used as monetary policy instrument. So, only a segment of the repo market data I will show you. The other segment, just like call market, I don't have. It's just not there on RBI's site. I don't know where it can be found. So, the definition of repo and reverse repo reversed from 29th October 2004. There was an announcement. RBI Bulletin has that announcement in the footnote. It was very funny. There is no data on market repo transactions. Only the monetary policy issue, we can deal with the data, how RBI is conducting monetary policy. For macro students, it is great news, because RBI's macroeconomic policy, like monetary policy, how it has been, if I look at the charts, we will know what RBI has been thinking when it decided to sell or go for repo transactions, when it decided to go for reverse repo transactions, and these are often done like auctions. The announcements are made by the RBI, banks come, they decide how much of money would go for reverse repo, how much of money would go for repo or whatever. If it is reverse repo, that day it will be reverse repo, no repo, and what the rate will be, etc. So, the discussion, empirical discussion we can have regarding this particular item would be RBI's monetary policy. But the other part, where banks, how much banks were directly involved with each other in repo transactions, which is nothing to do with monetary policy, it has to do with their having surplus funds, it has to do with their not having funds, not having securities for SLR. That aspect we will not be able to shed any light, because there is no information available on RBI site. Whereas, in case of call market, the entire information is on the market call rate, interbank call rate, what it is called. No information on DFHI call rate. Very interesting. RBI का अपना एजेंट बैठे हैं उधर, प्राइमरी डीलर, उसके ऊपर कोई इंफॉर्मेशन नहीं है. रेपो मार्केट में उल्टा इंफॉर्मेशन. ऑल राइट. नाउ, as you can understand, repo market is basically utilizing the securities already they have, or they are borrowing securities from somebody. So, repo market is definitely a secondary market. Repo market is not talking about investment in securities for the first time. If you have securities, you sell them for money. If you don't have securities, somebody else has bought it, you buy them from them. So, the entire repo market is a secondary money market. Remember that. The entire repo market is a secondary money market. It is not a primary market at all. Treasury bills market, I was mentioning that there can be a secondary market, there are secondary markets, but the entire discussion on my discussion on treasury bills were about the primary market. When government is selling treasury bills, they are primary market. But the repo one, if you look at it, the entire market by definition is a secondary market, not a primary market. All right? Okay. So, essentially therefore, the objective is you can call what RBI calls and macroeconomists prefer to use. It's an issue therefore, the repo market is short term liquidity management is the issue. It's a very short term market. It's called a short term liquidity management. So, the repo market is essentially objective is or the purpose is short term liquidity management. How do banks, how do RBI manage liquidity in the short term? So, the entire issue is short term liquidity management with a secondary market. That's the entire thing of the repo market is this. In the 80s, it was very active when all government securities UTI units were traded in the repo market. In 1992, a scam broke out when banks were found to have raised excessive funds through the repo which they could not return. Harshad Mehta case. When banks were found to it was the Harshad Mehta, no, 94 was the Harshad Mehta case. India is full of scams, every period you will find. 1992 there was a scam that banks were overdrawing funds from the repo market which they could not return. Subsequently what happened, government got very conscious, nervous. They did not allow all kinds of securities to be traded there anymore. They specified which securities you can use, and I guess they have specified treasury bills etc., few government securities to be used which are very safe, all right, like the 91-day treasury bill, 364-day treasury bill etc. But over time again what happened is slowly the repo market settled down, the scam withered away, and government slowly or RBI permitted all kinds of treasury bills, commercial papers, certificate of deposit to be used in the repo market. They opened it again. So, there is a lack of confidence. As soon as the scam was there, they became very tight about what to be used in the repo market. They only allowed the government bills to be used, then slowly they relaxed again, and presently every kind of respectable respectable and common securities are used in the repo market. All right. As I told you, repo market is a place to borrow money and also to borrow securities temporarily for USLR. So, it directly competes with the call market. And the repo maturity period, what I have found, what I have understood, it can vary from 1 week to 6 months. 1 week to 6 months repo. All right. 1 week, 2 weeks, 3 weeks, 1 month or 6 months. And there are also like call market overnight repos within 24 hours it would mature. They are very short term. All right. And on a day-to-day basis, the repos are renewed. Overnight repos. So, as I told you, the repo transactions are very much, particularly the RBI section of the repo market, which is a very important issue. I am going to come to that monetary policy, because I take a macroeconomic perspective here, which is very interesting. The repo transactions are definitely concerned with, connected with part of the repo transactions are with the monetary policy of the central bank in our country. And you will see that it is connected with CRR, SLR. I have already talked about the call market, so it is connected with the money market. And from the policy point of view, it is connected also with a very important traditional monetary policy instrument, which you find in the theoretical literature, which you find practiced in almost all countries' central banks, monetary policy instrument. Repo is one they are using. Bank rate is another one which other countries use a lot, we don't. We use CRR. But we have one monetary policy instrument which is we use them as well as other countries use them, and it is one of the oldest monetary policy instrument. It's a traditional one, and repo market directly competes with that too, and that is called open market operations. Open market operations, OMO. Open market operations are directly done by the RBI or the central bank of any country. It's a traditional money market or monetary, not money market, a traditional monetary policy instrument of the central bank. India also has it. It's simple. It simply does this. They deal with government securities, short term or long term, doesn't matter. They go into the market. When they sell them, they are absorbing funds from whoever, banks, non-banks, public, whatever. That's called open market sale of securities. And another one is the reverse of it, open market purchase of securities. When they buy the securities, in return they pump in money into the system. So the repo transactions directly compete with open market operations, except open market operations may be for a longer term. Once they sell it, they don't go back to the market maybe for 2 weeks, 2 months, 6 months or whatever, 1 year. Okay? Whereas repo market transactions are very short term money market, but they have a competition. So therefore, to sum up, these money market instruments have two dimensions. One, the free play of the market, whatever the market thinks they need, what they want to do, either in the repo or in the call market or whatever, or buying and selling of treasury bills. The other dimension is the central bank's monetary policy. What central bank as the guardian of the money market wants to do. And they use the call market indirectly through DFHI, which is called a primary dealer. It's like an agent, satellite of the RBI. In case of repo market, they do it under LAF. I'm going to talk about that soon. RBI's transaction, liquidity adjustment facility, LAF. It's coming. Next topic, very important topic. It's the monetary policy adjustment they do. All right. And of course, they have the traditional instruments in their hand. Bank rate, open market operations. Unfortunately, bank rate is not used as a monetary policy instrument in India. It's not active as it is active in Europe, in US, in other countries. But we use, instead of bank rate, we use CRR, which other countries are not using. Interestingly enough, they invented that instrument. They are not using it. If they had used it, they wouldn't have had this financial crisis, because CRR forces the financial institutions to park with a portion of their cash with the central bank, forces them. So if the banks are in trouble, central bank can always use that cash. What happened in the financial world, in the Western financial world, is that when the banks were in trouble on the non-banks, there is no kind of security money lying with the central bank which they can use to help them out. Big problem they got into. But in India, CRR is a very active monetary policy instrument, which is what? Which is central bank is deciding something to do with the system. One is the system playing it out. Call market may, repo market may, buying and selling of bills whenever they have surplus funds, a secondary market when they don't have surplus funds, sell them off. All right, that's going on, one business. Another one is the guardian sitting there looking at him, trying to do something with it. There comes the monetary policy instruments. Traditionally, two monetary policy instruments were there: bank rate and open market operations. In theoretical papers also you would find them, monetary economics papers. But then the new ones came, CRR and repo. In India, they are using CRR, repo, open market operations, though not the bank rate. In other countries, bank rate is very important. And in other countries, I don't know whether the central bank gets involved with repo transactions at all or not. The entire repo transaction in other countries could very well be, like the first world, very well be market repo transactions, which is within banks like the call market. In India, the repo market, which is announced on TV, which we study, is the monetary policy part of it, where RBI, the central bank, is directly involved. Now, I will show you a slide how repos are auctioned. I have a slide from RBI. I will show that to you if I have. How repos are auctioned for central government dated securities, long-term securities, repos are auctioned. And then banks, DFHI, financial institutions all come and bid, and there are cut-offs set. And then, and then repos are, tenders for repos are a minimum of 1 crore and multiples thereof. My goodness, repo transactions are a multiple of 1 crore each repo certificate. Baap re baap, huge amount of money transactions. So when they go for repo, that means there is too much of surplus, too much of a deficit. It's a multiple of 1 crore, what my notes are saying. We can look at check the numbers, repo amounts, multiple of 1 crore. Okay, so we will talk about that and something called LAF. I just mentioned this today. In the next topic, it will come. I will talk about LAF, Liquidity Adjustment Facility. I will talk about that next. LAF is a policy that they introduced the beginning of this century. And under LAF is the umbrella of policies. Repo, RBI's repo transaction is a very important item. So I will talk about that in the next topic when I talk about RBI, directly what it does. So it's all gearing up towards RBI's functions. So I take a very macroeconomic perspective in this course, which interests me, to be honest with you. I don't take the micro issues of a banking system, etc., what they do. So up to today, it's all right.